Ben Reppond. Welcome to my YouTube broadcast. Excuse me. Today is April 30th, 2025. I want to begin with the dashboards. Excuse me. This one shows as of last week in the yellow box, and in the pink box year to date. These are ranked based on where they fall on a year-to-date basis, not on the weekly basis. But you can see in the yellow box, last week was a good week. These are the 4 U.S. markets, which are equity markets, which are at the bottom: the Dow, S&P, NASDAQ, and Russell. And then the 20-year government, long-term government bond, and the for developed markets and emerging markets. And then year to date is in the pink box, and you can see the top 3 are positive, and the bottom 4, all the U.S. markets, are negative quite a bit for the year to date. The Dow down 5%, S&P down 6%, NASDAQ down 7%, and the Russell 2000 down 12%. It has really, the Russell 2000 has been crushed. To the right of that are the where they stand relative to their moving averages, going from left to right: the 20-day, the 50, the 100, and the 200-day moving averages. The developed markets have done the best. They are above all 4 of them. The emerging markets are above the first 3, so much more positive. The U.S. markets are, above 1 or not. And the government bond is above 1. So it really is kind of 2 different stories, the U.S. and otherwise. And the Treasury bonds are, slightly positive for the week and slightly positive for the year. When you take the S&P and break it down into its component parts, the sectors, there are, again, in the yellow box, you can see they all had a gain last week, except for consumer staples, which was down 1%. It has been up the most for the entire year, more than any other sector. And but last week it was a correction, and it was negative. You can see at the bottom, the ones that were the most negative were technology and consumer discretionary, and those did the best. Year to date, as I said, consumer staples, positive; healthcare, barely positive; everything else negative, and especially the bottom 3, technology, consumer discretionary, and retail, quite negative. And then where were they relative to their moving averages? You can see that to the far right. Again, the 20-day, there was enough movement in most of these to move them above their 20-day moving average. So here we are. This is a chart, a line chart that's a weekly chart showing where things are. One move in this line equals 1 week of data. It's a 3-year chart. And you can see where I drew the black line to show you where it has come from and where it is now. Still in an upward direction. But when it came down for the last 3 weeks, it's had some gain in it, and you can see that to the far right. And I point out with the red arrow to show that the direction in a short-term basis is still in a negative direction. I put the same data, same 3-year chart, weekly chart, with a candlestick. So you can see, using candlesticks, where those are. Last week, to the very far right is a fairly large hollow candlestick, which indicates that it started here and finished up here. A very positive indicator, particularly since the bottom of it and the top of it engulf the previous week. That was a red candlestick going down. So when that happens, that typically is positive outlook going forward. I took it and put it into a 3-month daily chart. So I'm moving now, keep in mind, I'm moving from a weekly to a daily, big difference. And I've compressed it from 3 years down to 3 months. So, but another look at the same, a piece of the same data. As you can see, the direction, the kind of intermediate term, let's just say 2 months of direction, is downward, represented by the black arrow. But when you take a shorter term look, maybe almost the last month, you can see that the direction is up and is even above its 20-day moving average. Different look than the previous charts where they were below the 20-period moving average. The NASDAQ 100 on a relative basis to the S&P 500, when this goes up, it is favoring the NASDAQ 100 growth stocks. When it goes down, it is favoring the S&P 500, which is the broad market, which includes growth stocks and value stocks. I put a couple of arrows just to show you over the last 9 months or so that the degree to which the broad market was more in favor than the NASDAQ 100. And then at the very end of it, you see that little red arrow, that's the degree to which the NASDAQ 100 was stronger than the broad market. So there is a lot of damage here on a relative basis where the broad market is more in favor than the growth market. Same thing, except looking at from a different angle. So I took the S&P 500, just the S&P, and split it into growth and value, and just said, okay, where are we, excuse me, where are we relative to each other? So when it goes up, that favors growth. When it goes down, it favors value, just growth and value. And so I put 3 red arrows pointing up, showing growth is in favor. And then I have 2 arrows going down. These are large moves. 2 arrows going down indicating that value is in favor. And this is significant to us. We don't use this as a method to manage money, but it does illustrate what we actually do, which is we have a growth and value approach. And so when value is in favor, and it has been at certain times, we move pretty quickly over into value. And when it is growth oriented, we move pretty quickly over into growth. We don't catch all of those moves, but general trends like this, our goal is to catch a good portion of them. The S&P 500 versus small cap. Well, small cap has been out of favor. I showed you that in the early dashboards, the Russell 2000 Small Cap Index. And when this goes up, it favors large cap. When it makes a move down, it favors small cap. And that's represented by the ETFs, SPY, and IWM. So you can see it's still in an upward direction favoring large cap. Long-term government bonds have done terrible for the last 5 years. Not a straight line, as you can see, but they have gone in a downward direction, causing a lot of difficulty for buy and hold 60-40 stock and bond type portfolios. And there are moves, where it is coming down and then it tries to go up and it can't because the momentum is not in its favor and it collapses, goes up and then collapses. How many times did it do that? A lot. So and if you looked at the intermediate term bond, the ETF is IEF, and it's the same thing. It's just a different magnitude. This takes it back to August of 24 to just show you a more short-term trend, and you can see this goes through last Friday. Again, the red candlesticks indicate that it's starting here and it's going, starting here and coming down. Hollow candlesticks start at the bottom and go up. So there is plenty of both, but you can see with the amount of red ones in there, That is, these are weekly candlesticks. There's a lot of damage that's been done. So I think it's going to take a while for it to work through that and resume being in an upward market. This is government bonds now. The dollar has had a trend up, but it has broken the 20-period moving average. These are weekly data. And you see from my black arrow the degree to which the dollar has dropped since about the beginning of the year. Gold, represented by the ETF GLD, continues in an upward direction. It's a 3-year weekly chart, well above its 20-period moving average, and it's doing very well. It's around I'll get into it later, but it's around $3,300 an ounce for pure bullion. Silver, SLV, had a very good week, and it also is moving up. But with silver, and I point this out, it's more volatile. It goes up and downwards, whereas gold does go up and down, but it has a smoother line to it. But silver is in an uptrend, you can see on the far right. Bitcoin had a good week. You can see that on the far right. It moved up sharply, is now above its 20-period moving average, and that's favorable for Bitcoin. The volatility index, the VIX, has been coming down. It's come down because we've had this period represented in the last week or so where the market has been going up, and if the market goes up, the volatility index tends to come down. So it's $24.84, and I put my marker there at 24, so you can see how far away it is from that. And I put a black arrow to show still the direction is higher volatility. I compare the U.S. to South Korea as a foreign market, just a foreign market. Their market, ours is SPY, SPY represents the S&P 500, theirs is EWY. And so South Korea has been in favor since late December relative to the U.S. market. So it's an indicator. It's an easier chart to follow because the two compare each other pretty smoothly. If it's going up or it's going down, it's not as jumpy as some charts. Okay, gold and silver. As of Friday, April 25th, gold is $3,319 per ounce, down 0.3% from the previous Friday. Silver, $33.02, this is the spot price, is up 1.8% from the previous Friday. The gold-silver ratio is $102, or 102.6 actually. And so I think of it as 100. So when the ratio is 100, meaning gold is way overvalued relative to silver, it is an indicator that silver is a better buy. This last week, I've talked about this before. I own silver. I don't go into how much I own, but I decided to buy more. Well, silver at $33.02, and when you put the markup on there, it's over $35. I believe that silver is going higher, but I don't buy silver for an investment. Those who talk about silver as an investment do not understand the nature, or gold, do not understand the nature of gold and silver. They are a hard asset, which has always been used as a store of value. It has intrinsic value. And and our currency is paper. So if you think that paper is going to be around forever, then why would you really need gold and silver? But if you think that paper one day, like all other currencies in the past, that other than gold and silver, is going to go away one day, or it's going to continue to be diminished in value, then you would want something as a store of value to help offset that. Since 1913, when the Federal Reserve came into existence, their printing machine was printing press was going pretty strong, and so the value of the dollar has diminished about 95%. It's worth about 5 cents on the dollar since the Federal Reserve came into existence, and but the value of gold and silver has gone up substantially and held its value from what it was in 1913. So that's my reason for buying them. Now, I did add to my amount that I have, and I told you this before. I'm going to go into it a little bit. My son Preston is in the precious metal business. He is in the Nashville, Tennessee area. The name of his business is Tennessee Precious Metals, and so I bought it from him. One, because he's my son. Two, I trust him completely. And three, his prices are amazingly attractive. And I'm just saying this because I know some of you own or want to own gold or silver, and the number one seller of gold and silver in the U.S. is a company called ST Bullion. S. Sam T. Tom. ST Bullion. And if you buy gold and silver, you know that probably. I think of them like the Amazon of precious metals, and they're an online company, but a lot of people use them. So as I was talking to Preston, I bought this. I said, just by the way, could you tell me how your prices are relative to ST Bullion? And he said, Dad, my prices most of the time, for what you're doing, most of the time my prices are lower. I go, really? That's amazing. He said, yeah, because I have very low overhead, and I price it to be competitive, and people tell me constantly that my prices are lower than theirs, and I was kind of shocked. I thought, how do you beat them, or how do you get lower than Costco, who's selling an ounce of gold for whatever they sell it for? He said, no, Dad, I'm very competitive. He said, the whole thing comes down to shipping costs. So if I have an adequate amount, quantity, just a reasonable amount, I'm 99% of the time I'm lower than they are. So I just thought I would tell you that. If you're interested, I'm just going to give you his name and phone number if you want to give him a call. If you're not, disregard it. Or you can send me an email or text, and I'll connect the two of you. So I'm just saying it because this was a time when I went ahead and bought some more, and I'm going to buy some more. I see me adding to my supply of silver over time, and maybe you might say, well, I don't need more, but it's a store of value. Okay. In Monster Box, it went up because silver went up. So it is now, that's 500 rounds of silver, went up to $17,650. That includes a $2.28 per ounce markup. And that brings it to $35.30. Now, when you get into larger quantities, like I said with Preston, it can be somewhat negotiable, but I know he always tries to be as competitive as he can be. But I use this as kind of a benchmark. This is a good price. You can use it as a benchmark if you want to buy locally where you live, but that's kind of where that's going. And the markup is a function of the market. So the price, the spot price, typically is manipulated, but the markup comes back usually to supply and demand. That's my opinion on it. Okay, that's it. If you have questions or comments, or if you want to contact Preston, there's my phone number and email address. Thank you.